State Street Corporation reported second quarter financial results with a 13% ROE and a 1.2 percentage point expansion in pre-tax margin. The company onboarded $1.2 trillion of AUC/A during the quarter, primarily driven by State Street Alpha. They also recorded over $140 billion of asset servicing wins and had solid net inflows in their global advisors business. State Street's balance sheet, liquidity, and capital positions remain strong, with a CET1 ratio of 11.8%. The company returned approximately $1.3 billion of capital to shareholders through share repurchases and dividends. In the second quarter, State Street Corporation reported an increase in EPS by 14% compared to the same period last year. Revenue grew by 5%, driven by front office solutions and strong growth in net interest income. Total servicing fees were down 3% YOY but up 3% sequentially. The company saw positive dynamics in AUC/A and AUM, with increases of 4% and 9% YOY respectively. Overall, State Street remains focused on managing costs while investing strategically in the business. For the third quarter, State Street expects a decline in non-interest-bearing deposits by about $5 billion. They anticipate a moderation in deposit rotation in the fourth quarter as they work through most of their backbook and central bank's pause. NII is expected to decline 2% to 6% in Q4 compared to Q3, stabilizing around those levels. Expenses are expected to decrease by 0.5% to 1% sequentially, with a focus on cost control. The effective tax rate for Q3 is expected to be between 21% and 22%. Eric Aboaf, Rob, we saw a favorable uplift in yields on our securities book, with a 21 basis point increase. The difference in yield between the front book and back book is primarily driven by the timing of reinvestment, as well as the mix of securities. Going forward, we expect further repricing opportunities that can support NII growth. Eric Aboaf, it's difficult to provide specific details on the upcoming capital rules as we haven't seen a proposal yet. However, we are always looking for ways to mitigate any potential impact and optimize our capital allocation across our businesses. We will assess the rules once they are released and determine the best course of action for each business segment.
Eric Aboaf mentioned that the impact of upcoming capital rules is uncertain, but they are looking to mitigate any potential impact and optimize capital allocation. They expect higher capital requirements, which may affect different parts of their businesses. The new rules will come with an operational deposit capital charge and a reduction in the lending book, while the second finance business may benefit. They will assess the rules once released and react accordingly.